We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Francis Hunt, CMT in Technical Analysis and founder of the Market Sniper. Francis, thanks for joining me today. How are you?
Great to be back with you, Tom. Thanks for inviting me.
It's always a pleasure to catch up. Of course, you and I have had some excellent adventures over the years, and I always look forward to being able to catch up with you and chat about what's going on in the world. So what is let's say the biggest thing on the top of your mind that you're currently watching right now?
It's debt markets, I'm afraid, Tom. Everyone is fascinated by what's going to happen next, for example, in the stock market. And I actually think that's a bit like having two football matches going on, and you're staring at the under nines in your local village, and the World Cup final is happening behind you, where you could see Argentina versus France, for example. And the reason why I sound like I'm belittling, calculating what's going on the equity markets is because there's duality of forces going on there. There's chronic fiat debasement, which is actually what in nominal, and note I go nominal terms, is keeping equity markets close to all-time highs. However, within that, there's chronic fiat and debt debasement, which actually is showing in Swiss franc terms, the stock market's already turned down quite substantially. In gold terms, what you thought was a high wasn't even a high. And we've done that rebasing of a lot of asset classes. This is the time for the anti-fiat in our worldview. By the way, just as we were recording, and it is Wednesday here, the US just got their inflation numbers in, and they were expecting 0.2, and it's coming on, that's for the core PPI. My apologies, I said inflation, I mean producer price inflation. The PPI numbers core PPIs come in flat on a 0.2 expectation, where the previous was 0.4, and the PPI month on month is coming flat, also on a 0.2 expectation. And I've got the gold chart in front of me, and it's absolutely ripping. So the trade is a much longer trend than most people realize. They think, oh, gold is like last week's trade or last month or, April's trade. And no, it isn't. It's going to keep on keeping on. Gold has just shot up to 3,369, literally on the back of that. And we've got a macro setup that is very exciting, that we anticipate is going to be bringing home the bacon and taking us to the 3,700 level. We had platinum trigger earlier before that data. And that is also going to outperform gold potentially. And we've had silver that's been ripping so well that it's actually managing to bring the gold-silver ratio. And I fear only a demand-destroying event could create a reversal of that. Although I do feel that the part of the year when that's highest probability is now coming. Our August, September, October, probably into November vibe. There's lots of things that could be going down. And that's kind of what's filling my mind right now. And I don't know where you want to mine down first.
Maybe let's start with what you see as the possibility for a demand destroying event, Francis. This is something that obviously we can't tell exactly what it's going to look like, but is this something that becomes very deflationary for these economies? Is this something that basically takes the price of markets, the price of metals, and basically these in some ways these risk on assets all down at the same time before, let's say, metals typically rebound? Or how do you see that playing out, and what do you think is the catalyst for it?
So the actual story could be anything. For example, I've mentioned to a few people that there's a Plandemic Mark II in the UK being drilled for, called Pegasus. It's an operation that the statists are organizing. That's in August. At the same time, you've got the EU doing a launch of the euro kind of October, September, October. I missed the exact month. It's one or the other. So there's a lot of things going around this part of the world that seem very well coordinated. And that could be that could be the tagline headline event. But the truth of the matter, what's really causing it is the fact that we're in deep trouble with the debt and the long end is absolutely ripping, particularly. And it's not just the long end in Japan, for example. And by the way, I want to put out on our channel, for 2 years we've been covering massive calls to the upside on rates for Japanese debt. That suddenly became a topic that everyone cared about in the last 2-3 months. No one was discussing it 2 years ago. We had upside HVFs. We said the long end, the 30-year, all going significantly higher. Now this is a real threat. At the same time, you've got the yen actually collapsing. So the key point in that is rates can go up for your currency, but if it's a loss of faith, selling of the debt instruments, the currency is also being sold and it's going somewhere else out of the debt markets. We've seen a clustering into the Swiss franc. We've been trading leveraged on the Swiss franc, JPY, which has been a short yen, long Swiss franc. So money is flowing around, and the way you build wealth is getting in the front of that. You've got the UK debt reaching for new highs. By the way, it's beyond where they were, the rates, on all the major debt, long-term debt instruments, to where Truss was when she was fired. So the long end's being lost in the United Kingdom, and then you've got the long end in the here in the States, closer to home for you, which is also in essence going a lot higher. In fact, why don't we start on this? Because the real story is the financial plumbing that is the debt-based system is in a loss of value and is about to get disorderly again, I fear, to the upside. And maybe that's a chart you'd like to see. Let me know.
Yeah, absolutely.
So let's share that and get it up straight away. So here we are with the 10-year. And by the way, the 10-year is the shorter end of the long end, if that makes sense. It's not 20 and not 30, and I will be showing you that now. And it's amazing to me how many people are, yeah, this is just range chopping. Actually, by our technical analysis, it's not range chopping at all. You've had a little bit of a complex leg there into that low. That determined the range. That was a target make on a call we'd made over here on a W bottom. That was when it ran 5%. That was a top of 5%, by the way. So it's a key level. It would have hit the news, would have hit a lot of headlines there. And whenever the headline started, the trade's over. It's not about to start. So what did you get? You got a big pullback, a bounce, and then a pullback into lows down here on rates at 3.6. So that defined the range. But what's actually happened is you come all the way up to 4.8, and you've not gone anywhere near as far. You're at 3.9. 4 has turned into a little bit of a hard floor, and we're starting to move up. And you say, yeah, I can kind of see a little bit of a move up, but it doesn't look like it's about to fail. Well, it's given us a great technical structure. And I'm going to be referring also to the yield curve reversion, which people have stopped talking about since that has reverted. This is our draw tool. This is our prediction for continuation. And you'll see that purple line. Let me move those two handsome faces away there at 6.15. That's going to really think of what that does to commercial property, what it does to pensions that hold commercial property, what it does to residential in America, which is already suffering from a glut of inventory. This means loss of access to finance, a correction in the housing market. That does for real estate. There's a contagion of events that comes out of this, Tom, that is going to be quite brutal. In our opinion. And for those that say, well, it's just range chopping. That is a winding up. It's taken a little longer because it had already done a lot. But this has been in an upside trend, and you rest. I've got to remind people on the longer time frame. When you were lower down, it was much easier to rip, but you still had winding up continuation patterns all the way. Falling wedge over there. Broadening, a slightly falling wedge again over there. And now you're in the structure on a bigger time frame. But because you haven't moved out of the 5 versus the 3.8, 3.9 range for a while, people have got docile. And they've thought that's it. This is exactly how markets move. They keep on keeping on until an irreversible force of equal or greater magnitude is pushing in the opposite way. And as yet, that's not anywhere seen. And if I just take you to the real long end of that, and 30, for those that think listen, I don't see that breaking up. The 10-year's actually been in a range, but if you look at the 30-year, you can actually see it's been bleeding out a lot more to the upside. They look similar, but also they're different. If you have a look at this, you can see right here, right now, Tom, we're almost at all-time highs as it is. The degree that we're off, I say all-time, when I say all-time, I mean since COVID. It's not obviously all-time since Volcker, because obviously that goes a lot higher. But here you are, and you're moving up with real momentum as well. You got a tiger in your tank. You're motoring, and you're 2.89% off the low. So that tells me throughout this process there wasn't a lot of buyers coming in over here. The yield getting higher means the bonds are getting lower. The TLT made up. It's an ETF made up of the longer end, 20 plus, and that is ready to make new lows. If you have a look at it with me, from our call in 2020, that first inverted HVF right up there, into a head and shoulders, into a break, made the target to the downside. Everyone is way too docile about the loss of valuation in debt. That's the big thing. And here's the dichotomies of this crazy situation. Normally, raising rates, bad for Bitcoin, bad for gold, precious metals, bad for the stock market. Yes, generally in the 90% that's in the middle. The 5% on the two extremes, if you're thinking about the bell curve, when loss of faith is happening in a reserve asset, the money is actually leaving debt for those other anti-fiat reserve assets, which is gold, which is silver, platinum, and will be Bitcoin if it's continued to be perceived as an alternative and an anti-fiat and not a debt instrument. Although you have to look at the relationship with Tether and buying stable coins and buying debt as well with some suspicion, but let's just leave that one there. It's part of the anti-fiats, and we're seeing the alt start to run. We're seeing a beginning of a turn in Bitcoin dominance for those that are crypto heads. So this is going lower. This is a short. Remember, you don't just make a head and shoulders target, you pause for a while and have, but in the long term, you go, it's an end of a 40-year cycle. You're going lower. And unless you think the debt bubble's completely been deflated and all the jobs are done with the excessive proliferation of debt, which when you look at the big, beautiful bill that's going to be coming out, there's no way that's happening. I mean, that's a Liz Truss moment. We're going to borrow more, only on a much bigger scale on a hegemon. And this is how the market's reacting. Long-term debt ETF down, rates up across the range. And it's the same on the Bank of Japan. It's the same on all of them. We can bring up those charts. But let me let you come back at me for a bit.
Well, I think, Francis, before we move to the Japan, this basically the unwind of the yen carry trade here, I want to stick with that idea of the demand destroying event. And let's say the perception that many have of the Fed's ability to come back in and save the markets if, we do face a demand destroying event here. So, how much control do they actually have on interest rates? And, how big are they going to have to come into these markets to be able to have any effect on them if that's what happens?
So the expectation is that the central bank has all the tools to continue to bail everybody out. And in the normal environment, they generally have, because they could just draw on the overdraft. And the overdraft is essentially they go to the primary dealers and they say there's trouble in the land of the global economy or the world economy and our nation economy. As a result, we need to dip into the overdraft. You're going to need to buy. And they normally do it when there's already some degree of fear in the market that sees money flying out of the stock market, out of all other forms of assets, and wanting a fear haven. And they capture that flow and offer to match it debt-based instruments. And that flow of money comes in and drives the flow of debt-based instruments. That means it's a favored, deemed to overperform assets class at a time of fear. Your problem is now that the whole world the Western world particularly, is looking with a jaundiced eye on the debt category of asset class altogether. So whether you're Japan, whether you're the United Kingdom, or whether you're the United States, it's not an interesting asset class for people that do for-profit trading. Let's leave it there. And it's underpaying in yield. It's got a lot of capital downside, and you've already experienced that with the TLT that did a 52% collapse in around 3.5 years. So how badly do people want to continue to catch that plummeting knife, being paid substandard yields and eating massive capital losses? Not really. So that's why central banks themselves have been buying gold. And actually, the reserve asset of choice is something that'll still be there by capital, and it's the capital preservation over, return of capital over return on capital narrative. And this is what's happened. The debt market actually has only begun a process of unwinding 40 years of absolute ludicrousy and excess. Don't forget the 100-year Vienna bond that went out at 0 point whatever it did. That is peak lunacy. That is the shooting star on the top of the dot-com Cisco valuation and Sun Microsystems that's now turned into the NVIDIA 4 trillion star. So they need to crash to even get a semblance of bid in debt. They would need to completely crash the equity markets and cause flight capital that needs a home. And the problem is a large part of that capital, when spooked, is going to run into gold, silver, and other things because they understand the debt markets are not actually the trade. So you'd only get short-term money potentially, where previously the treasuries and the debt markets and the bond markets all over the world would get the bulk of crisis money at times of crisis. That doesn't hold anymore. The 40-year bond bull is over, and that's the answer.
So, Francis, then moving towards, again, this idea of the unwind of the Japanese carry trade, or the yen carry trade, sorry, is this the possible catalyst that kicks a lot of this off because of that unwind of all of that leverage within those debt markets and in turn in the stock markets as well?
So our particular view is we've even done an image for this. I don't have it to hand to share, but in essence, you've had a slave nation, Japan, here that does real low-cost wholesale funding, and you have a casino dominant master nation here, which is the United States of America, and there's a conveyor belt. Like, think of it as a trade, or even when you check out at the till. And what comes is cheap money that starts in yen. It goes halfway down the conveyor belt. There's a little house there that crunches it, turns it into USD, and sends it into the casino, and that money goes into the casino. And the conveyor belt, like any conveyor belt, there's an underside to it, but not much is going back. So it continues to send in one direction for a while. And one of the reasons why I think we've been winning, because we had a beautiful technical setup and we trade technically, but I always ask myself, what's the reason the yen's going down harder? Now, many people will go, that's obvious, they've got more debt, but they're not a hegemon, and all their debt is declared. Actually, if you include the unfunded liabilities in the US, actually, I'd argue that America, as a hegemon, has exported way more dollars and is way more indebted and less likely, despite the demographics in Japan, to probably be, in truth, even more indebted. Chicago professors have put it at over 660% when you count welfare and Medicaid. So there's ways that you report liabilities, and a lot of things are kept out of that equation. But regardless of that, the one concern they have is because I suspect that the carry trade runs a lot deeper. America has become a much bigger casino than people realize, and Japan was forced into a low funding nation. It was forced into the boom that caused the collapse, kind of a front runner for a debt collapse. And now we're getting, so it had the super low rates, and it's been the funder for the next stage in America. So what is the unwind of, how does the carry trade unwind? Well, at the moment, why is the yen going down? It's got to be kept weaker than the dollar because the long-term yields on the Japanese rates are going up. So if you had borrowed and you intended to do not just a short, people wouldn't have borrowed on the short end of the Japanese debt. If they're going, I'm doing career making trades, I'm going to be a hedge fund guy, I'm going to get a whale of cheap leverage capital, I'll get 100 million USD locally, and I'll borrow 900 million but in yen, converted into dollars, and we'll have a billion fund. That way, if I get 3% a year on the difference on treasuries, I'm actually giving a return of 27% instead of, or going on 30 potentially, and I look like a star, and I'm paying a much lower cost of capital in Japan, and I'm harvesting the yield. Let's say it stayed within debt instruments and didn't also chase Mag 7. Some of that's occurred as well, I would imagine. But if you've done that, if you start to have a much higher cost of long-term capital because the yield rate is going up, you're no longer getting the margin you were once getting. And if you don't want that to unwind, you actually need the yen to underperform the dollar, because that's the only way actually that reduction in yield doesn't throw you out. And remember, the Japanese yield rate, if it's a hedge fund, they won't have got the exact rate. They would have had a margin on top of that. There's a bank involved, there's an intermediary. So you actually have to squeeze some of that amazing differential quite a lot down. And now that we're getting the long end moving up, that's getting ever more squeezed. So the point is the yen has to go down because you need the repayments and interests to stay the same if the yield is going up for the carry trade to survive. So I think we're seeing a sustaining moment in the death or the tail end of the carry trade, potentially. It's a theory. I'm speculating. I can't prove anything. I'm just wondering and talking aloud. And I think the carry trade goes a lot further than people think in terms of the financial industry. That's given a lot of cheap alpha to people that weren't particularly special, took long-term deals on the assumption, after me the storm. If I get 10 years of this, that's great. And, I can retire in the Hamptons as a multimillionaire earning 20% and 2, and I've just got cheap funds and I've just added the leverage and got moderate returns. And that ends. How does it end? Well, if we get a violent reversal in the yen, and that's why it's one of the charts I watch an unbelievable amount. We've had recent volatility. You may recall there was a little bit of a yen vibe in last year, around about August, that ran into the lows of September on the USD JPY. And it was quite brutal how the dollar sold off there. So that was a little bit of a wobble moment. And where that entire volatility structure that's set up, and again, it's a chart I can show you, it's if it ran 141, we'd start to get concerned. Right now, it's doing the exact opposite. Even though the dollar's been weak, the yen has been made to be the whipping boy of the FX currencies, and the franc has grown in scale as a reserve currency, which has been behind our good fortune on that trade that was technically set up. So that's how things could go wrong, but it does need a reversal in the currency to do that. And we're now seeing the long end of Japanese, above 3, and also high momentum. So it's closing that differential a great deal. So the attractiveness of the yield delta is reducing, and the possibility, if the currency reverses, that could then leave people forced to repay debts or to declare bankruptcy or to start to have liquidity issues and then declare bankruptcy, and you'll have a lot of upset Japanese banks and intermediaries that provided loan capital. And it's not only the America, but it's very distinctly an American phenomenon. But I think there's probably been that kind of leverage, maybe through Switzerland, applied in Europe and other places. So we don't know how deep that trick of one economic cycle has gone.
Francis, when we think about, again, going back to this idea of any type of demand destroying event, usually people run to the dollar for safety. And, the dollar has had some very interesting moves basically since Trump came in. The value of the dollar has gone down quite a bit. And it seems like we're kind of at a crossroads here. And there's really two camps of really predicting, or the idea of, basically the milkshake theory of dollar going up versus, more, let's say, more devaluation for the dollar. How do you see that playing out?
So we had the debt devaluation, which was the collapse of TLT, as we highlighted to you before. And that typically follows I call them the twin sisters. Money's borrowed into existence. You've got to think of them as two lead balls with a rubber band tied between them. And if I roll one down the staircase, the other one isn't going down at the same time, but there's a bit of traction, a delay, and then it slows down because it's being held by the other one, but then it pulls the other one down towards it. So you get the sort of staircasing down of these the currency market and the debt market, which again, this is your World Cup that I say everybody should be watching, because this is the foundation of the economic system. Everything is layered on top of it, right the way up to equities. It's capital formation and IPOs. This is all money, banks, all of them have to exist. If you have a collapse of the debt market, you don't have any of these. You have counterparty failure, you have bank failure, you have all of this. Even our trading accounts will be cleared out, et cetera, et cetera. There's such risk if this goes badly wrong. And what's essentially happened is you had debt devaluation, and now you've had dollar devaluation. Now you're starting to see the rates going up on the 10 and the 20. So we're going into a second stage of debt devaluation. So you could get temporarily, relative to other currencies, many people thinking the dollar is oversold, you could get a rally here if you're measuring it against a euro, and it's already beating the yen at the moment, short term, and maybe even a pound. But those are all lepers in a leper colony that are slightly unsynchronized, but they've got the same disease. And they're all in different stages of it happening. The Trust Kwarteng had a super spike on their debt, but they're now higher than that on the long end, but it's not disorderly. So people have kept calm, but it's consistently getting worse. Trust me, Labour's long-term plans in the UK are going to assure a debt-based collapse, more so than the stimulus package that she put forward. And in actual fact, it was the Bank of England that didn't match the rates at which debt the US was hiking, that probably contributed a lot to the panic on the debt. I did a YouTube today, Tom, and just on that Trust Kwarteng thing, because I treat that as a microcosm of exactly what's going to happen to a lot of nations. And I said that it'll happen to America. And then we got the peak tariff tantrum when the US spiked in rates and the dollar crashed. And everybody's told you it's different for us. We're a hegemon, milkshake, everything. What actually happened is you had a chronic move in rates, and in actual fact, the dollar spilled. And what happened there? Gold went up and got bought. So hegemon, it's different for us. All of these copium narratives, if you're getting a loss of faith trade against you, you are not only getting your asset class sold off, you're getting the money removed from your boundaries. And that means it's leaving the dollar too. And the anti-dollar trade is gold, by the way. Even Americans staying with their money in the country, dumping dollars for gold, is an anti-dollar trade. So if you close out your pensions, you get it self-invested, you force them to sell all the bonds that they're holding, and then you receive a dollar amount and you go purchase gold. You just dunk the dollar and the bond market. In doing so. And you can be American. So a lot of people coming up with, it's the Japanese that did it to us, the Europeans, the Davos crowd, there's some peculiar, and I'm all for a conspiracy theory, but a whole bunch of peculiar conspiracy theories. I've got the stats. It was quite clearly Americans that had started to purchase, or money that originated in America. It could be offshore money that's been long-term settled in America, but it was Americans not buying American assets and starting to overweight in European assets, and it was capital leaving from within America to without. And a lot of that will be American billionaires, American hedge funds, a lot of that. So people want to nationalize things. This is a debt-based collapse with a hegemon, and this is how it goes down. And the hegemon is on a 26-rung ladder, and everyone else is on a 4-rung ladder. So one breaks his ankle, and the other one has his head smashed like a tomato that's just been flung against the tarmac. That's how it goes. You're falling from higher. You've been an exporter of paper, and you've let everyone else produce everything for you. This is how bad it goes when it unwinds. You're falling from a higher rung ladder. And it's difficult to get that. It sounds like I'm attacking people. There's a lot of emotional response to this. It's not a friendly narrative. I love the Americans. Buy gold. preserve your capital. I would still say contemplate not seeing this downdraft and tax scavenge mode and everything that goes down with all of this. By being in America, I understand that's a horrible message. I had to leave my homeland. It's not an easy decision. But knuckle up for a rough old ride. Yes, you can point out China's had a housing boom bust. You can point out Europe's a mess and all of that. But the hegemon falls from higher. It doesn't change that fact.
So, Francis, in that, from that perspective, is gold and, other parts of the metals complex, let's say, are they, starting to sense that and basically starting to attract those dollars and that capital into those markets?
I 100% believe so, by analysis in the charts, Tom. Everyone can have a fancy opinion and talk a great story and tell a narrative. The question is, what's the chart say? What are the price movements actually pointing to? So I've spoken about a quite a lengthy period now where we have not had a particularly big move. We defined a range. I want to share this chart. You're asking, what's going to happen? Is there a real substitution debt? So we've confirmed that debt is heading up. We showed the bleed out on the 30 and the 20-year on the US debt, and we showed a continuation pattern squeezing starting to move out on the 10-year. My theory, you're going higher on rates. Forget all you think you're going to get. That's why there's this friction between Trump and Powell, because Powell is caught between the rock and a hard place. He'd maybe quite like to deliver cuts and not have this Punch and Judy show, which is all really a bit of kabuki theater, in my opinion. But in the long run, he'd probably not like to be so much in the limelight at the whole Trump narrative. But this is what gold. So we talked about the rates setting up a continuation pattern to go upside. Look at what gold is doing. There's your 3.5 again, key rate. Remember, the 10-year was at 5%. Here's your continuation pattern for gold. That's what it's doing. That's what it's doing. It had such a strong, by the way, April of this year, remember I said to you, debt rates spiked, dollar collapsed. Here's what gold did. So it had a super surge. That's gold super surging to 3.5. Okay, after you've done such a fast move, you were sitting at about 2.9 here. We'd said you'd run the 3,000 and have a pullback. There was the pullback. And then you got tariff tantrum. That's what gold did. Bang. Okay, if you're going to move that much in such a short time, you're entitled to a continuation pattern and a breath. It went from jogging to sprinting. So there's some degree of, okay, we've held the 3,250 here twice since the exhaustive move up and down, and now we're squeezing and we're going to go higher. Some might say, well, you're still in the range, Francis. I'm not sure that's going to happen. We have, again, HVF method, draw tool. We'll pop it on and we'll show you why we've been talking about a breakthrough to 3,700 and possibly 3,750 on a little bit of overperformance. There's the setup. It's dancing on this line. We call this the break and the feign back in. It's dancing on the line that is our triggering event, that green line over there, and it's pointing to 3,694, and we've got other targets in and around that level. A confluence that's basically 3.7 to 3.730 stroke 50. So if you think about the key levels, once we'd run 3,000, the next one was 3.5. We ran it, and then we had quite a substantial pullback. What's the next level between 3.5 and 4? It's 3,750, isn't it? And there's your confluence of targets. Remember, derivatives play a role in this, and it's called pegging, the law of round numbers. So that's what's gold doing. And just a couple of metals that are correlated to gold right now, also in a similar structure, already with a draw on it. Here is platinum. The true white gold, even rarer, and look at that breakout. And that's it. It's happening right now. There's our stop loss placement. There's your triggering event. Right now, as we are talking, you and I, on that terrible rates, PPI inflation number, which probably points to a wrecked economy, this is going up. But I don't care if it had even come in hot. Target you're talking in and around 1500, 1487. Now, I've got trades on in 900s with a 9, with 3 digits. And we're going to 1.5 soon next on platinum. It's the outperformer of the year right now. So, I mean, that is, yeah, I mean, you can see it right there. So, I mean, that's platinum. And then, of course, everybody recognizes that silver had an absolute bolter. I'll just take the volume out. And it broke out very, very similarly. Up, up, up. A little bit of hammering now, getting ready to go. So it's super surge. It was during this week, it was the outperformer of that was last week and the week before. A little bit of a pullback after running because gold hadn't yet broken, but gold's getting ready. So that's what the rest of the metals are doing, and they're the less big ones to gold, but gold will follow now. But it's no longer almost the leader. Now the smaller guys are waking up and they're sprinting. Gold is the big old king. He gets up from his chair slowly and he strolls up the hill. These other guys are runners, and they're getting their running shoes on. So if metals are all in technical setups to the upside, and rates are all in technical setups to the upside, which means debt valuations are downward, about a breakout to the downside, I don't think it's a ridiculous conspiracy theory to say people are divesting from a devaluing asset paying a crap yield that doesn't meet inflation and getting into a preservational asset like gold and silver and platinum. So, I mean, I think that's not opinion, that's charts. And I always come back to that because I want to know what's the trade. Everything else is people's best guesswork, but that's the charts.
Mm-hmm. Francis, do you do any thinking around what this environment within the metals, this expansion of margins, what effect that has on the miners of those metals?
We've started to see a bit of a turn for a lot of the better quality miners, and certainly twitching. First Majestic, which has had its problems, but has got a lot of silver in the ground, is now, been a bit of an underperformer, now looking a lot livelier. And that's going to come down to, there's a rush for physical stuff. So there's two worlds. There's a dichotomy. Them to you, go get digital. Biometric is awesome. Crypto is awesome. We're going to do this. We're going to do that. BlackRock behind the scenes, governments behind the scenes. Where do we get the XYZ resources? Scavenge mode for stuff and things in an environment where fiat and debt debasement, which goes hand in hand, as I keep pointing out, if you've had a major debt debasement in your bond market, you're going to get a commiserate currency buying power devaluation. So those guys are saying one thing and doing another. Larry Finkelstein, as I call him, is absolutely ecstatic about tokenization as a concept, and you declaring and having an NFT that shows everything you own in the internet. I don't think that's a good thing for you, whilst at the same time is getting into every single country. He's buying up properties, distressed properties all the way. Even in the UK, they're talking about BlackRock acquiring. When and where are the people that call for the breakup of BlackRock? It's time. They don't have a diverse enough board. I want to see it diversified out, and I want it broken up into small smithereens. These guys are they brag about escaping your national government. They see themselves as the transnational government over you. These are right to rule people. BlackRock is not hated enough. We need more headlines demanding the breakup of BlackRock. Hear me now. It's your enemy. It's your biggest enemy. They're directing everything. And when you give your assets to be managed, you buy Bitcoin in a BlackRock ETF, you are giving them proxy votes of power over you, and they have nefarious agendas that are actively working against your welfare. And people need to understand that. So a little bit of a reset comment thrown in there with great enthusiasm, but buy your own gold and custody your own gold. If you want to buy Bitcoin, custody it yourself. Don't buy ETFs in these transnational megacorp assets managers that are pursuing all forms of very nefarious activities.
Francis, something that you and I touched on this morning before we hit record here was basically the idea of questioning a premise or a narrative when you're sure of it. So, there's a lot of times where I know for myself, I've learned this, where I'm, very resistant to, let's say, enter a trade or to close a trade because I'm just, a good example of this, let's say, is when there was a run up in a particular miner and I just thought, oh man, this thing's going to the moon. I'm not going to sell. And I was just sure of the continued performance of this. And within a day or two of that, it reversed and just completely got decimated. So talk to me a little bit about this psychology when you're very sure of an idea and how you question that.
It's a good question. There's two parts in what you were saying, because you did ask a question about the miners before that. And I think there's a personal experience that you're wanting to share without getting into the details about that. And I do want to say to most people, yes, there's a space for miners, but I'm a massive fan of getting the metals because it's a simpler trade. You're getting the product. The problem with miners is, have they been diluting equity? Have they lost silver or gold ounces in the ground? Have they got good operations? You can get lost in the weeds of a lot of other aspects. Are their costs disproportionately also climbing as a result of the fiat debasement? In which case, the price go up, the costs go up, the margins actually don't really change so much. So I keep it more simple. The gold ounce is the product and it is the king. And that's why I've benefited with the silver price climbs and all of that. And sometimes initially the miners lag those. Will there be a period where all hell breaks loose and the miners absolutely rip? But it is a bit like the altcoins, and it's funny to use a much newer industry as the base standard, but somehow people get this easier. How many times have people called the alt run only for Bitcoin dominance to continue? And part of that is because it's a reserve asset crisis we're having. And Bitcoin is the reserve asset, or perceived to be, the digital gold, whilst the other things are actually tech and new railways. Eventually, we start to think about what's the replacement system, and this is the priority. I think that's already been thought about, but the money starts to flow there in a bigger way, and that's when you see it. So I do think, and I keep warning, play the stages. The best position is actually to hold the metals initially, have some minor action. I mean, I've got Agneco Eagle. I've done Grader on it. I had Orla before it, but those had technical setups. And I've literally had one equity at one time. You would think someone who's such a gold bull would have an absolute portfolio of equities. No, I'm swapping one equity for another, and I'm only allowing myself, and only that capital that's ring fenced in that pot gets rolled into my next one after a target make. And actually, I have a disproportionate weighting in the actual end product, which is the gold, silver, and the platinum. And I'm not saying I've mastered it and I'm so smart, but I'm saying so far for the stage that we're in, it's served me well. There will come a stage where I'll look a little more conservative, and I could have done XYZ, and ABC Mining Corp got bought out for 4 or 5 times its market cap, etc. That will come, but I think there'll be time for us to shift that allocation. So there's that, and then your question was the psychology of conviction, the other part of it. So I tend to, when I've made conviction errors, I just can't see something not doing it. It's usually on the day, on the spur of the moment stuff. It's usually, wow, there's that thing. And I saw it the other day and I thought it might do that. And there it is. It's just ticking and it's done exactly what I should have done. And then it's like, whale in. That's where I make conviction errors, and it's emotive. And you've obviously got to have a stop loss and a method. Thankfully, I do, so I don't have accounts wiped out. But then you're like, wow, I never saw that happen. That shocks me. I was totally wrong, and it did a reversal. When it comes to the debt-based collapse and the macro, I don't want to sound arrogant in saying this. I'm rarely absolutely wrong, because I've had good days, bad days, felt sick days, felt positive days, felt negative days, unhealthy days, healthy days, 5 espresso days, no espresso days, stimulated nervous system, unstimulated nervous system. If I keep coming back to the same situation and the same outpack, and I'm prepared to always wipe the slate. How do we be wrong? Really ask that question in this trade. Because if you don't say, listen, I need to actively try imagine a set of circumstances where I'm wrong. This is a thought-based exercise. And you've done that and you really still say, wow, I can't see any of that happening without it still having that knock-on effect here, there, or everywhere. And you're coming to the same conclusion. I will say I'm rarely wrong there, but that's not anything special about me. Anybody who's, I would say most money managers that trade big macro themes will probably have the same process. It might take longer sometimes than they think. There might be a bit more churn in between. You know, you've seen this yields on the 10-year, but they end up, it starts coming and it comes hard. It's a bit like the silver people that have been really conviction and they've walked a real desert. And now they're starting to finally feel justified and there's so much more to come. They always felt sound money. They saw the fundamentals. Now, I do that both technically and fundamentally. And I keep getting to the answer. So I'm trying to prove 1 + 1 = 1 algebraically, mathematically, geometrically, and every other way. And I'm still getting 2. And that's why on the bigger time frames, I feel we don't get it wrong. The guessing the time, that's a different story. When the actual timing, that's a different question. And you could argue that people that were buying silver for the last 2 decades, I was always concerned it might become unobtainium, actually are wrong for not having bought the NASDAQ tech index for 9 of those 10 years and just pivoted recently on account of timing, because if you're far out on timing. But for me, this was always an accumulation for the biggest macro trade of them all, which is the collapse of a system. And I thought, I don't trade small. That's why I say don't get it stuck into the equities, because on one hand, you've got disinflation across consumer, so there's going to be bad consumer stock performance potentially, and some small hands retail are going to buy. But then you look, 87% of the stock market is held by the top 10% of Americans. They're living just great. Those are all, 10 million plus individuals, and right the way through to billionaires. And you're getting currency debasement. So there's disparate forces pulling the stock market in different directions. Nominally, I think the stock market goes up. It's not having a melt up. It had a spill. It's retraced, and it's now gone nominally higher than it was before. That's not the melt up that some people have been calling, and actually nominally it's gone down when you rebase it to CPI even, and the Swiss franc, and definitely on gold. So I think equity is not the place to be. Debt-based collapse and the real reserve assets is the big game. It's the World Cup football match that you've got the front row seat on. This is the trade and the investment hypothesis and model of my lifetime. At the end of this, Tom, I shouldn't need to work ever again. Neither should my children and their children, if I've done this correctly. Now, I don't know when other people start. It might not go 3 generations. But if you're just starting now and you're starting with 10 to 100 grand and you're getting engaged, you could get into a situation that you live you won't be as badly affected by the people that have had their pensions obliterated in debt. I want to tell you this one story, and that ties into on pension crashes and the promise to citizens that is going to be reneged upon, and the bad news will come, and why that invariably points to a UBI CBDC-based solution. In a video about Liz Truss's event, Tom, what actually happened is the pension managers were being coerced and encouraged by the Bank of England to buy debt. So they wanted a steady big lump of money that's coming in every month, ready to buy and gobble up all this issuance of over expenditure that the UK government was doing. When the yields got so low, this is getting to the end of the 40-year bull market, the pension managers were saying we're not getting enough yield actually to make the payments on the pension. So they got together and they created an LDI, a leveraged instrument. Forget the 3 letters. I can't even remember what the D was for. But basically, it's an acronym for a Ponzi scheme. What it involved is buy your 100 billion. Let's say you're a massive pension fund that you were going to buy over that year. You're not getting the yield. Here's what we'll do. We'll take it as acceptable collateral, the Bank of England and the banks, and you buy, providing you buy a second allotment, and we'll take that second allotment as collateral, and you don't have to pay. You only have the 100 billion, but we'll get you up to a position, say, of 500 billion. I'm just choosing random numbers here. To be quite a big pension fund if it was that big. And now, with 500 billion, where you've only paid for the 100 billion, you're getting 5 times the yield. You can make your pension payments. Now, you, as well as I, and this is explained in a YouTube, how the Bank of England sold the story to pension fund managers and they went with it. So, okay, you're not getting enough yield. Give us all the money you have, and we'll allow you to collateralize, buy more until you're getting enough yield. Well, all that does is make them continue buying a crappy asset and buy so much of that crappy asset till eventually they get the outcome they needed, which means if that crappy asset then turns and starts having down valuations, their collateral, 100% of their collateral, say you bought 500, let's go to million instead of billion. You had 100 million and you bought 500 million. You lose 20% on that asset. Essentially, you've lost the entire allocation to bonds. Mm-hmm. So interest rates started to go up. They were already going up. It wasn't Truss's fault that they were already going up. It's every government before then. She hadn't had time to start spending money, and she was actually trying to do a stimulus budget. So the system was so hypersensitized because of pension fund gearing on debt, on these leveraged instruments, which essentially meant you were buying way more than you could afford to buy, and thereby were more exposed to the capital devaluation on the asset. That's complete Ponzi-onomics, Tom. Mm-hmm. And as I say, I can share you the snippet where it explains what an LDI is. Basically, you just keep pledging the collateral. This is the same as the Japanese that bought a building and collateralized the building with a mortgage and collateralized the building and got given full value for the building and got levered up 10 times and then could go and buy 10 similar buildings during the 80s and then could go and pledge that as collateral and got levered up to buy 100 off of the 10. Each time getting 10 times the leverage. You know how the story ends. And that's why I say it's a controlled demolition, because nobody cared for the longevity of the game if they allowed and knowingly had such an instrument created. Because the simple and obvious thing about this entire Ponzi is what happens when the capital value goes down? You lose 20%. Essentially, a pension fund is trading, but not day trading, is long-term trading in leverage where it could get a margin call and actually have lost the full capital value of the asset it's supposed to be using and gardening and manufacturing and nurturing to pay people's pensions. Mm-hmm. So it's absolutely their intent. And they know it's coming, that everyone will lose their state-based pensions that are going through the official pension fund process. And those pension funds are liable. And the Bank of England that coerced and helped and developed through investment bankers this leverage product are all party to the destruction of the pension system. And now that we've turned the 40-year bond call, which is why I say it's the most important call we ever made in 2020, is the end of all of these things. And there are people walking here, I'm in Edinburgh right now, on the streets right now, thinking, thank God I contributed for 35 years, 40 years of work, and I have a pension because the world's going to hell in a handbag, who are going to get a very big shock as a result of not knowing what those assets are and how those pension funds have actually been affording to pay them their monthly stipend. And that's all going to blow up. And you're going to have a lot of old people with very outdated skills that are largely unemployable, apart from checkout cashiers at your local Tesla, at your local Tesco and Walmart, that are suddenly going to have to go back to work or are going to be then given a UBI with biometrics and all the conditions after they've been made to struggle, scream, and strike. That's where I think you're going. That's the reset thing. And the banks are part of it. The central bankers are part of it that used investment banks that built mines, landmines into the system. It's literally me. It's almost as if I was laying landmines, Tom, in your driveway and your back garden. It's almost, there's no longevity in the process. I need to get rid of this explosives and this poison and this toxicity and all of this, and I just put them there in the back garden. You're actually parking up a problem for another day. And that points to active intent rather than incompetence. Mm-hmm. Because you don't need imagination to say, the asset can lose 20% and somebody who is now margined, it's just trying to get through the day and destroying tomorrow. There's no reality, there's no sound money, and pensions are supposed to be conservative instruments. That's why they were buying conservative assets. pension managers should rather have found a better yielding with better capital gains possibilities assets, and instead, through a combination of coercements, enticements, with a central banker involved, has led them to make leveraged investments in poor assets right at the end of its 40-year bull cycle. And that's a travesty. And if they did that in the United Kingdom, and we're all globally synchronized to be in a state of collapse, what will be unearthed in the United States in terms of funds and their continued support for treasuries? What will be unearthed in Europe? What will be unearthed in Japan, where they were the original ones doing that in the property game, where I've already described using buildings as collateral? So this is a controlled demolition, and we're at the end of a debt-based experiment, and fiat debasement goes hand in hand in that. Reserve assets are the legacy reserve assets that were the reserve assets. That's the summary. It's the executive summary. It's the story. It's the greatest trade of your life, and it is the simplest, biggest trade. Don't let people with funny, highly detailed complexities let you lose sight of that ball. That's the trajectory. Keep your eye on the ball.
Mm-hmm. I think that's the perfect place to kind of bring this in for a landing here, Francis. You know, the change of this 40-year debt market, I think there's a big part of recency bias going into the continuation of it, but also being able to kind of back out and see these things from this longer term view is extremely important and extremely instructive on where this is going. Francis, I always appreciate getting to speak with you, and thank you for walking us through all of this. Of course, anybody can find you at the Market Sniper everywhere, anywhere and everywhere they want to. Always a pleasure, Francis. Thank you so much for your time today.
Absolute pleasure. Start on the YouTube channel, by the way, with the Market Sniper. And we look forward to helping people. It's the trend that's going to keep giving. It's the biggest of them all.
Mm-hmm. And if anybody's interested, they can book a call with you as well, right?
Indeed. Links are in the description.
Perfect. Thank you so much, Francis.
Bye for now, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.